Consumer price, CPI, came in at 2.4% year-on-year and at a small 0.2% month-on-month. That's hovering towards 2% target. This is providing hope that the U.S. inflation problem could be starting to ease. Core CPI is also trending downwards at 2.5%. It's the lowest since April 2021. Now bear in mind that the Fed looks at PCE more than CPI. But anyway, this is still quite a bit of good news. Inflation fell to the lowest since May 2025. Key items like food, gas, and rent are cooling off, while tariffs had clear impact on products like furniture, appliances, and apparels. But the key items are cooling off. This basically provides relief for middle-class and moderate-income families. That will also boost consumption. Jobs growth was stronger than expected to start off this year, coming in at 130,000. It was slightly under 50,000 in December last year. This provides some form of relief. January this year is the best month for payroll since December 2024. And like always, healthcare led the biggest gains at 82,000 positions. Some might argue that healthcare, broadly speaking, always needs jobs. While the overall is good news, but some might say that it'll be even better when you see more private sectors, like tech and financials, start to hire more. On to unemployment. It dropped to 0.1%, lending at 4.3% now. So even though the job market is largely frozen, it's stabilizing. The 130,000 gains in January are enough to stabilize the market for the time being. Hourly earnings increased at 3.7%. It's decently above the 2.5% inflation rate. So now, tying everything up, it's still a solid data point which pushes the story towards a robust economic growth and supporting consumer spending. So lastly, the talk about interest rate cut. Very likely it'll happen after mid-year. Sometime around June, July, there will be an 83% probability for rate cut, and the new Fed chair will be announced before that. Let's look at the U.S. government budget deficit. January's deficit is much smaller than a year ago, thanks to the strong tariffs collection. From tariffs, they collected a total of $30 billion, which puts it at a 304% year-on-year jump. Basically, the chart on the right shows that the government's income is mostly lower than the amount that they spent. The tariffs reduced the deficit quite a fair bit. It's down about 26%. The whole point of Trump pulling his tariff strategies is to increase government revenues. Over the course of 2025, gold prices jumped about 66%. The main reasons are geopolitical tensions, unpredictable trade policies, and concerns about the independence of Federal Reserve. So being a natural safe haven, investors turned to gold for hedging. But at the end of January this year, gold prices slipped about 10%. But nonetheless, it's viewed as a correction, then a spark of bear market. The main reason for that sell-off is the nomination of Kevin Warsh as the next Fed chair. But then gold prices very quickly recovered. So next, many market watchers continue to see upside for gold prices. Let's look at the picture at the right. You'll see the breakdown of gold across the world. T stands for trillion. The biggest one is in jewelry. And then, a lot of people are holding it in bars and coins. Central banks definitely hold a lot of gold. And then industrial uses like some semiconductors require gold. Then, let's look at reserves underground. Ultimately, the reserves amount will start to drop. This will provide a support for the prices in the long term. Let's look at historical data and use it as a benchmark and forecast. 1971 to 1980, there was a bull run in gold. It jumped from $35 per ounce to $835 per ounce. Throughout this period, gold prices fell many times. The longest correction lasted 105 days, and the sharpest decline was 19.4%. So the recent 10% drop is considered half of it. And put it this way, during then, these numbers, the jewelry, bars, central bank, and industrial users weren't that high. So viewing in today's lens, with this kind of numbers, the likelihood of prices dropping close to 20% is rather low. Another bull run occurred during early 2000s to 2011. There were 5 price corrections, leading to a decline of 16%. There are many factors that currently support gold prices. The biggest one is the persistence of central banks' demand. That's an important driver. On the right, since 2020 to 2025, you see the changes in central banks' gold holdings of the respective countries. China bought a lot of gold. Poland, Turkey, India, Brazil, and so on. And the ones below are those who sold. So having central banks buying more, this will support the price in the long term. Looking at the photo at the right, this shows the value of gold that respective central banks hold. Some investors looking at current gold pricings and moving averages, 50-day, 200-day, and whatnot, there might be some signs of saying it's overvalued. But from Barclays, a certain amount of premium to gold's fair value looks durable, suggesting it's not a bubble now. And the key things that support the price are inflation, U.S. policy uncertainties, and decline of dollar, which is also why many central banks are buying more gold. Some comments from UBS: the gold bull market typically doesn't conclude because fears diminished, which is what's happening now with the nomination of Kevin Walsh, nor when prices are too high. Gold's bull market will end when central banks establish credibility. Right now, this is pointing towards U.S. Fed and highlighting the past cycles, 1970s, 2000s, and the recent 2020, gold prices increased whenever investors doubted Fed policymaking. And UBS forecasted gold prices to reach $6,200 in March, and then falling to slightly below $6,000 by the end of this year. This is a fund that launched in December 2025. I invested with my own money in late January, and I've been tracking it daily. It seems okay, and the recovery from the dip on 30 January recovered very quickly. What's different about this fund is it tracks the performance of LBMA gold price. It doesn't invest in equities of gold mining and gold-related activities companies. This fund is backed by investment-grade gold bars with minimum fineness of 99.5%. So this meets the LBMA standards. And the gold bars are vaulted in Singapore with 24/7 security facilities. LBMA is London Bullion Market Association. It's a global benchmark for wholesale gold, often referred to as good delivery, and it's recognized by central banks and institutional investors worldwide. The links are at the info section below. UK economy last year, Q4, 2024 to 2025, only grew 0.1%. Last year, the key pillars didn't really do well, like services, and construction registered the worst performance. But going forward, manufacturing activities picked up. Services industry also experienced an influx of new activities. Hopefully, this will progress further and lead into an improved outlook. UK is important when you're investing into Europe area because it's the top 2 economy. Very recently, Bank of England kept interest rate the same at 3.75%, because inflation rate is still relatively high at 3.4%. But many economists are predicting this to ease further, and there's a likelihood to have an interest cut in Q2 this year. So lastly, China consumer price increased lower than expected at 0.2% year-on-year. Deflation in producer prices persisted. It dropped 1.4% year-on-year, slightly lesser than December's close to 2% drop. This deflation has been going on for more than 3 years, hurting manufacturers' profitability. The biggest reasons are low consumption, low consumer confidence, and disruptions stemming from U.S. trade policies. But not all is bad. This recent data is distorted by Lunar New Year, which falls mid-February. It makes more sense to treat January and February as a combined reading. So next, People's Bank of China reiterated that they'll implement looser monetary policies and will issue the full details sometime in March this year.